We've got some earnings this week. It's not just the big banks. Pepsi reports tomorrow after the bell, and it's one of the few consumer stocks, even if it's a staple, sitting near the highs. Rebecca Walser joins us, president at Walser Wealth Management. Rebecca, welcome back to the show. Tell me why you got Pepsi on your mind.
And it's the shorts are low, the earnings are really strong. The ROE is incredible, Oliver, as you know. Certainly, they have a little bit large long-term debt to equity is high. But you know, they are they're a staple, as you said, and there's definitely a little bit cheaper than Coke usually. So even our Coke users, we know in recessions will move over and buy Pepsi. So that's why we think this is a good performer in this quarter, and we're expecting about 172 tomorrow when the earnings per share when the numbers are released, and we think that we'll be doing well for the rest of the balance of this year, especially if we are heading into more and more tough times for the individual consumer.
So this isn't really a company that needs to show us big, impressive top line growth. They don't need to be like booming in sales. They just got to keep the bottom line together, pay out a dividend, make everybody happy.
Yeah, exactly. And you're looking for the things that consumers will not cut from their budget. We've done studies on this, believe it or not. We know that people will people will spend money on Coke. They will always go they have to have their thing, but a lot of consumers will go to store-bought or will go to Pepsi. And so we do expect Pepsi to fare well the rest of this year for sure. So to get, it's a hard market right now, as you know, Oliver, to pick a winner, right?
It is.
We usually say, hey, let's go to utilities, energy, and staples. But even in the staples, people are going to be very selective now. So it's really important that you get something that people will be able to still afford through these difficult times. And people really don't like to give up their cola,
Any thoughts on what kind of information they might give us about the supply chain? Is Pepsi a useful gauge of that inflation discussion right now or no?
I mean, it's very distributed, obviously, and it's mostly their formula is obviously what gets distributed. So that isn't such a concern as it is with the supply chain, with technology and the smart, all of the smart facilities being promulgated through China. So we're not as concerned about distribution and supply chain with a Pepsi as we would be with Intel or any of the others that are so reliant on China for supply chain. But certainly the whole world and distribution certainly impacted with any kind of shutdown with shipping across the world. So that's always a concern. But I think that the overall factor for viewers is where are the stalwarts that are going to lead us through? And it doesn't have to always be the sexiest, like you said, the newest kid on the block that has to really prove themselves. Sometimes we just need to go back to the basics and say, what are people going to still buy, even when they have to scrimp? And we think this is a good one that they will. And it's had an incredible, ROE. The ROE is over 60%. That obviously is reflective that they have very high long-term debt, but that is, the manufacturing process when you're building these massive factories and those kinds of things. Obviously, Pepsi does a lot of distribution that's distributed, obviously.
And when you're going for staples, when you're going for companies that are able to withstand economic stress, does that mean that your baseline expectation right now, Rebecca, and your overall strategy is that our economy is slowing down?
Oliver, unfortunately, I definitely track the GDP now out of the Fed Atlanta, and it obviously shows for the second quarter still negative growth. So we do expect, obviously it's not officially confirmed, and there are other factors. It's not just a hard and fast two quarters back to back with negative growth, and then we're in the recession. There's other factors, obviously inflation, unemployment, all these things, with the exception of the unemployment number we got on Friday that were to the positive, which was wonderful. We need some positive information just anywhere right now. Most of the factors that we're seeing are negative. We do still expect mean reversion of the S&P back towards where it was really more supported before all the stimulus of coronavirus. I don't think that the world understands how much we stimulated, since March of 2020. And now the Fed is just having to not only stop the stimulus, which obviously we've done, but also reverse course. So instead of QE, we're at QT. Instead of interest rate cuts, we're at interest rate hikes. And, Oliver, we've never seen the speed at which they are raising and tightening at the same time. It was an experiment to print this much money to sort of stave off a depression from coronavirus. And now we're on the other side of that experiment of how are we going to really get this money populated into the world without massive inflation becoming ingrained into entrenched in prices. And that's really a big problem. So we are definitely looking at equities, unfortunately, still retrenching for the balance of this year. And you're going to have to be very selective to pick up the growth areas that are going to be challenging because things keep changing as we have, new lockdowns. You were just speaking of it, and across the world because of coronavirus. That again then distorts what we are expecting companies to be able to achieve over here on this side of the pond.
Okay, well said. So I guess that means you think we're locked in for 75 basis points, Rebecca. Is that the July expectation?
I hope not. I think that the market, I think that's too aggressive. I would really much rather see 50 basis points. But I was really surprised when they pulled the gun and the trigger, and they let's be honest, the Friday jobs report for June obviously gave them more ammunition to say, hey, we're not affecting employment. We can keep going on this faster tack. But I just think that the markets don't like it, obviously. And although this past June, the market seemed to roll with it quite well, I think it was almost expected. So I don't know if the market's priced it in yet. I would much rather see a 50 basis point raise, but it's looking more and more, if they're looking at the data, and they've definitely go off of the labor market data from the Bureau of Labor Statistics on Friday, then I think that they will be able to justify it.
Okay. All right. Good stuff. Good catching up, Rebecca. Thanks. Appreciate the stock pick too.
Thank you. Thanks.
Absolutely. Rebecca Walser, president at Walser Wealth Management.